So let's just take a look at the following activities and figure out, are they measured in GDP? Sometimes they are, sometimes they're not. And if so, what category are they measured in? So this is consumption, this is investment, government spending is G. S, we're going to call savings. Savings is money that is taken out of the economy for future consumption. T is going to be taxes. Oh, those are, those things that we have to pay. X is exports, IM is imports, and we're saying N is not applicable. So a student gets her hair cut from a self-employed hairdresser. Well, assuming that, the student is paying for it, that is consumption. And that, by the way, is a service. The hairdresser buys a pair of scissors from the Ace Beauty Supply Company. Well, she's not buying it for her household, she is buying it for her business. It is a piece of equipment from her business, so we would call that investment. Out of each day's revenue, the hairdresser puts $50 in an RRSP. So she is taking money out of the economy right now so that she can put it back in later in the form of consumption. So we would call that savings. And because it's going into a financial institution, it qualifies. If you just put it in your piggy bank, it doesn't really qualify as savings. It has to go into a financial institution because then it becomes loanable funds. GM expands its computer facilities at its head office. So GM is a company, it is expanding its computer facilities, so buying more equipment. We're going to call that one investment. American tourists go skiing in Canada. Now we have to think about that. Initially, a lot of my students go exports, and or rather imports. And the answer is you have to look at where the money flows. They earned the money in the States and they're spending it in Canada. So money flows into Canada, therefore it is an export. Now it's not your traditional export like you're used to seeing, but we've got one of those coming up. 2 Canadians go to Tokyo and stay in a hotel while I am taking the money that I earn in Canada and I'm going to spend it in Tokyo. So money flows out of Canada and we will call that an import. Russia buys beef from Alberta cattle ranchers. Oh, the money is flowing into Canada. That is an export. And Saskatchewan pays to build a new highway. Well, we're talking about the Saskatchewan government here. So when a government does something, it is government spending. So what I want to do right now is a quick little problem on page 110 of your textbook. Let's see if I have it here. So you're given some information. And they are looking for some other information. $126, depreciation is 64, government spending is 198, imports are 118. I've got something here called net foreign factor income. I'm just going to leave that for now. And negative 22. And indirect taxes. I'm going to leave that one as well, because what I want to focus on here are some subtleties that students tend to forget. So it says, what is the value of GDP at market prices? So GDP equals consumption plus investment plus government spending plus your exports minus your imports. Because remember, net exports are exports minus imports. So, other thing to remember is that we use gross investment. Are we good to go? I got consumption, I got gross investment, I have government spending, I have exports, and I have imports. I am good to go. So that's going to be 430 plus gross investment is 126 plus government spending is 198 plus exports are 130 minus your imports of 118. And just give me a second now to calculate that. And you should get 766. Your answer will be a dollar amount. The second thing is, I will always give you units. We are not told if this is thousands, millions, or billions, so we just assume it's straight up dollar. So that was pretty easy, but there's a couple of things there. What about if I hadn't given you gross investment? What if I had given you net investment? Then you have to remember our formula. Or maybe I will ask you for net investment. So net investment equals gross investment plus, pickles, minus depreciation. So that's going to be 126 minus 64. So I'm going to get out my calculator, 126 minus 64, and that's going to be 62. And the answer again is in dollars. That means that we have added to our capital stock. If this were negative, then our capital stock would have shrunk, and our depreciation would have been higher than our gross investment dollars. Another little subtlety, what about net exports? Let's go find our net exports. Remember, net exports equal your exports, which in this case are 130, minus your imports, which are 118. And that, I'm going to say 12, but I did it in my head. Me doing math in my head is not necessarily a good thing. So $12. Now remember, if I had said these numbers were in millions, you'd have to say it's 12 million. Please note, I always write out my formulas. I want you to write out the formulas, because if you just put numbers there and the numbers are wrong, I cannot give you partial marks. So always write out your formulas. Oh, speaking of formulas, there's no formula sheet. No, you don't need it. So I expect you to know these formulas. This GDP is C plus I plus G plus X minus IM. It's going to be with us the entire semester. All right, so that is gross domestic product. So that is the amount that the economy has produced, the value of production. So if personal income is 900, personal income taxes are 200, and consumption is 600, what is the value of savings? So my disposable income equals my personal income of 900 minus the taxes, which are 200. So I have YD equals 700. So disposable income is 700. All disposable income is either consumed or saved. So savings, therefore, equals 700 minus a consumption of 600, which is 100. And you can have negative savings. A lot of households in this country spend more than they earn. So in this case, savings would be 100. So I said, hey, why don't we try problem 11 on page 113, because, gee, that would be fun. And we have here some data. And this is exactly what you're going to get on your midterm and on your assignments. And basically, you're asked to calculate a bunch of things. Now, what I tell my students when you're first starting out, don't try and memorize this all at once. Use the framework that I just talked about. So if you have to, I think I'm going to add a worksheet that's got blanks there so you can fill them in. So use the framework and see if you can solve it. So we're going to be asked, this is number 11, right? We're given a bunch. Now please note, all figures are in billions. So one of the first things we're asked to do, A, find consumption. B, find net exports. Whoops. C, find gross investment. D, find GDP at market prices. So that's enough right now to get us started. So I'm looking at that consumption. Consumption. What do I need? I need disposable income and I need savings if nothing else is given to me. Let me see. I got personal savings of 100. I got personal income tax of 160. Oh, right above that, disposable income, 820. So consumption is disposable income minus my savings. I'm just reworking the formula where I had disposable income equals savings plus consumption. So that is going to be 820 billion, don't forget your billion, minus my savings of 100 billion. So that is going to be $720 billion. If you give me $720, I have to mark it wrong. Think about this. There's a huge difference between 720 bucks and 720 billion bucks. I would much rather have $720 billion. Your net exports. Well, that is simply your exports minus your imports. Notice I'm writing out the formulas, people. I expect you to do the same. So I'm looking at all of this information. I got exports, so that's 45 minus my imports of 85. So my net exports are negative $40 billion. So that would indicate to me I have a trade deficit. Gross investment. Gross investment equals net investment plus depreciation. And so that is going to be net investment, 90, plus depreciation, which is 80. So that's going to be $170 billion. And then it asks for GDP at market prices. So remember, GDP is your consumption plus your gross investment. Big mistake I see students use net investment, wrong, plus government spending, plus your exports minus your imports. So I'm looking at that and I see here, ooh, that's my consumption. So that's 720 plus, I didn't forget the billions. I'm just not going to write it out until the end. Gross investment. My gross investment was 170. Plus my government spending on goods and services, which is 240. Plus, now I can either put in my exports and my imports, or I can simply just put in my net exports, entirely up to you. Since my formula, I used exports minus imports, I'll just put them in there. So when I get that 720 plus 170 plus 240 plus 45, syntax error, 720 plus 170 plus 240 plus 45 minus 85, I should get 1090, and I do. So that is 1 trillion 90, oops, 1 billion, sorry, 90 million. Oh no, it's billions. 1 trillion, $90 billion. That's what you have here, folks. So that is what I will be looking for on your assignments. Then it says, hey, why don't you give me gross mixed income? And I'm thinking to myself, this one's going to be a little tricky. So remember, GDP equals, according to your thing, GDI. And gross domestic income equals your compensation of employees, your gross operating surplus, your gross mixed income, plus your taxes less subsidies, plus your indirect taxes. So that means that my gross domestic income, I already know the answer, is 1090 equals my compensation of employees, it's right here, 620, plus my gross operating surplus, which is right here, 190, plus X, that's what I'm looking for, plus taxes less subsidies on production, which is 90, plus indirect taxes. Where did you go? Right here, 130. So 1,090 equals 620 plus 190 plus 90 plus 130 equals 1030 plus X. So X, of course, is my gross mixed income. So gross mixed income equals, which I'm just going to say X equals 1090 minus 1030. And that, my friends, equals 60 billion, don't forget your units, dollars. So I'm going to leave you guys to calculate the rest of that. You've got to get net domestic product of basic, net or national income, and then personal income. And the solution is actually in the answer key. So if you go to answer keys in the course content, you'll see it there. All right. So some other calculations that come up in this chapter are calculating nominal and real GDP. All nominal means, and you're going to see nominal in the next chapter too. Nominal, it simply means current or stated. So nominal dollars are current dollars. Real simply means, hey, I'm going to convert this into a base year. So this is a very simple example of calculating nominal and real GDP. And we're going to use 2016 as our base year. So whenever you have nominal GDP, you will see that there's a base year, and it's arbitrarily assigned. I could have used 2017 as the base year, but I didn't. So what happens is that nominal GDP is simply, now this fancy sign, if you haven't done stats, is the sum of your prices in the year times your quantities produced in that year. Real GDP is the sum of the prices from the base year. So in this case, we're going to use 2016 as the base year times the quantity in the current year. So the current year in this case would be 2017. So if I have machines, kilometers of roads, breads, and cars, those are my products that are produced. This is an old textbook example. I don't know where they got it from. Then all I'm going to do is multiply. This is my quantity, this is my price. Multiply those out. So 100 times 100, can you believe I'm using a calculator, is 10,000. 50 times 300 is 15,000. 500 times 2, woo, I can do that one in my head. And 20 times 800, that's 16,000. So now this says, hey, add them up. So I'm going to do 16,000 plus 1,000 plus 15,000 plus 10,000. And that gives me $42,000. So that's the value of goods and services produced in 2016. So nominal GDP now I'm going to do the nominal GDP in 2017. Nominal GDP, current year prices, current year quantities. So 120, that's going to be 14,400. 40 times 320 is 12,800. 600 times 250 is 1,500. And 25 times 820 is 20,500. So now I'm going to add up all of that. So 49,200. The problem with nominal GDP is that I want to know, well, did I actually produce more stuff or did the prices just go up? And the reality is that nominal GDP, look, we got machines went up by 20 bucks, kilometers of roads went down by 10, or sorry, prices went up by 20. So I actually want to know, well, did I actually produce more stuff? And the only way you can figure that out is to calculate real GDP, because real GDP says, hey, I'm going to use the prices from the base year, so I'm going to hold my prices constant, and what I'm going to do is multiply by the current year quantities. So I'm going to use 120, and the price of a machine in year one was 100. The price of a kilometer of road was 300. Price of bread was $2. And the price of a car, can you imagine? I mean, what kind of car are we getting here? It must be a little car for a kid. All right. So for real GDP, it is the prices in the base year times the quantity in the current year. So it's going to be the prices for 2016 times the quantity for 2017. That's how you get real GDP. So 120 times 100, 12,000. 40 times 300, I think that's 12,000 too. 600 times 2 is 1,200. And 25 times 800 is 20,000. So now, again, I got that funny symbol, the sum of, I got to add it up. I'm going to add up that column and you get $45,200. Yeah, so the answers, by the way, are in dollars. So now I can take that and I can say, hey, I got my real GDP in 2017, and that's 45,200. So because it is greater than my, oh, I jumped ahead. What about my real GDP in 2016? Well, in your base year, your real GDP is the same as your nominal GDP. So now I can finish that thought that I had 60 seconds ago. Because my real GDP in 2017 is greater than my real GDP in 2016, I know that the economy produced more goods and services. Because I held the prices constant. So over here on the next slide, it's all been done. And what we're going to do now is to use this data to calculate the deflator. So we could compare what has happened to nominal GDP and real GDP by calculating the deflator. No, this should say, by the way, GDP deflator. So the deflator is an index number derived by dividing nominal GDP by real GDP. And it looks at the average change in prices of all the items produced. So the your GDP deflator equals your nominal GDP. So you calculate it for year, so I'm going to say in the current year. Your nominal GDP in the current year divided by your real GDP in the current year. So let's get our GDP deflator. Oh, and you multiply that by 100. For 2017. Well, for 2017, I'm going to use my nominal. Oh, and by the way, I forgot. Yep, that's right. Right here. 49,200 all over 45,200. Going to multiply that by 100. So 49,2 divided by 45,2 times by 100 and, oh, pickles, times 100, times 100. 108. You get something that's 108.85 psi. So all that means is that the prices of goods produced are essentially 8.85% higher in 2017 compared to the base year.